Welcome to Early Indicators. Today we continue our February domain on environmental tipping points with a theme that sits at the intersection of climate volatility, financial stability, and community resilience, the global insurance retrenchment, the quiet but accelerating withdrawal of insurance coverage from regions facing rising environmental risk. This is not a headline-driven crisis. It is a structural signal in the clearest sense. Signals are structural, not events, early, not reactive. Underreported, not mainstream, and directional, not episodic. Insurance withdrawal is one of the earliest and most consequential indicators that environmental risk is transitioning into financial instability. To understand how we reached this moment, we need to trace the long arc of climate-linked financial exposure. In the 1970s and 1980s, insurance markets absorbed weather-related losses without major structural strain. By the 1990s, rising disaster costs began to pressure insurers, but the industry remained confident in its ability to price risk. The early 2000s brought a shift. Hurricanes, wildfires, and floods began producing losses that exceeded historical models. Reinsurance markets, the insurers of insurance companies, started raising prices and tightening terms. Over the past 15 years, climate volatility has accelerated, and the gap between insured losses and actual losses has widened. What once appeared as a cyclical challenge has become a structural transformation. Entire regions are becoming uninsurable. Several forces converged to create this inflection. Climate change increased the frequency and severity of extreme weather. Urban expansion placed more assets in high-risk zones. Economic development amplified exposure in coastal corridors, fire-prone regions, and floodplains. Governance gaps left local infrastructure underprepared for rising climate stress. Reinsurance markets tightened as global losses mounted. These forces reshaped macro-scale systems such as housing markets, municipal finance, and global capital flows, while also influencing micro-scale systems including household budgets, small business viability, and community resilience. Current signals show the shift with growing clarity. First, insurance companies are withdrawing from high-risk regions. Not through dramatic announcements, but through non-renewals, premium spikes, and reduced coverage options. Second, reinsurance costs are rising globally, forcing insurers to pass costs to consumers or exit markets entirely. Third, mortgage lenders are tightening requirements in regions where insurance availability is uncertain, affecting home values and loan approvals. Fourth, municipal bond markets are beginning to price climate risk, raising borrowing costs for vulnerable cities. Fifth, new policy documents from multiple countries quietly acknowledge that insurance retreat is becoming a national-level economic concern. These developments rarely dominate mainstream coverage, yet they reveal a system under mounting stress. Signal confidence, accelerating and transformative. Here is where the shift is most visible. In California, wildfire-prone regions are experiencing insurance withdrawal, forcing homeowners into expensive state-backed plans and reducing property values. In Florida, rising hurricane losses are driving insurers out of the market, increasing premiums and straining household budgets. In Australia, flood-prone communities are facing premium spikes that exceed mortgage payments, prompting discussions about relocation. In parts of Europe, river basin flooding is triggering insurance restrictions that affect housing markets and municipal planning. These examples illustrate how insurance retrenchment reshapes systems at every layer. Nations must reconsider disaster response frameworks, housing policy, and financial stability planning. Cities face rising costs as insurance withdrawal affects property values, tax bases, and infrastructure investment. Firms encounter operational risks tied to supply chain exposure, facility insurance, and regulatory shifts. Communities experience rising household costs, reduced access to financial services, and increased vulnerability to disasters. Individuals face higher premiums, limited coverage, and declining property values. At the macro layer, insurance retrenchment alters housing markets, municipal finance, and global capital flows. It influences migration patterns, economic stability, and national risk exposure. At the micro layer, it affects households, small businesses, neighborhoods, and local ecosystems. The fragility revealed is profound. Financial systems built on assumptions of insurability are colliding with a climate reality that is becoming too volatile to price. Future expectations point towards several trajectories. In the short term, over the next 1 to 3 years, more insurers will withdraw from high-risk regions, and premiums will continue rising. Mortgage lenders may tighten requirements, and state-backed insurance programs may expand. In the medium term, over 3 to 10 years, housing markets may experience divergence between insurable and uninsurable regions. Municipal budgets may face strain as tax bases weaken and infrastructure costs rise. Reinsurance markets may consolidate, increasing global financial exposure. In the long term, beyond 10 years, insurance retreat may reshape national economic geography, prompting relocation, altering political landscapes, and redefining financial stability frameworks. Entire regions may become economically unsustainable without major adaptation investments. Early indicators to watch include premium spikes, non-renewal notices, reinsurance market reports, mortgage lending changes, and municipal bond pricing. Potential tipping points include the collapse of insurance availability in major metropolitan areas, widespread mortgage defaults tied to insurance withdrawal, and the emergence of new financial instruments designed to manage climate risk. What to watch next? Pay close attention to regions where insurance withdrawal, declining property values, and rising municipal bond yields appear together. These clusters often signal where financial instability will accelerate first. Watch for early policy responses, such as insurance pool expansions, relocation incentives, and new risk pricing regulations. These developments can reveal where governments anticipate future economic stress. In summary, the global insurance retrenchment is one of the most consequential environmental signals of our time. It reshapes housing markets, financial systems, municipal budgets, and community resilience. It reveals fragilities in economic structures built on assumptions of stable risk. And it offers early insight into where climate-driven financial instability will intensify in the coming decades. These signals are quiet, but they are deeply consequential. Thank you for listening to Early Indicators. If you found this episode valuable, please like, subscribe, follow, and share. Your support helps bring attention to the signals shaping our future. This episode draws on publicly available information, including international think tank reports, academic research, public climate and policy data, open-source intelligence, and non-copyrighted summaries of global developments. No proprietary or confidential sources were used. This episode is for informational and educational purposes only. It does not constitute political advice, financial guidance, or predictive certainty. All interpretations are based on publicly available information and are intended to support general understanding of global trends.